Hi. Let's learn about the accumulation/distribution indicator, A/D. The accumulation/distribution indicator is a cumulative indicator that uses volume and price to assess whether a stock is being accumulated or distributed. The A/D measure seeks to identify divergences between the stock price and the volume flow. This provides insight into how strong a trend is. If the price is rising but the indicator is falling, then it suggests that buying or accumulation volume may not be enough to support the price rise and a price decline could be forthcoming. The A/D formula consists of money flow multiplier, money flow volume, and A/D line. The money flow multiplier is derived from the close, low, and high prices of the period. It helps gauge the strength of buying or selling during that time. Money flow volume is calculated by multiplying the money flow multiplier by the period volume. The A/D line is then calculated using the previous A/D value and the current period money flow volume. The A/D line helps to show how supply and demand factors are influencing price. A/D can move in the same direction as price changes or in the opposite direction. The multiplier in the calculation provides a gauge for how strong the buying or selling was during a particular period. It does this by determining whether the price closed in the upper or lower portion of its range. This is then multiplied by the volume. Both of these technical indicators use price and volume, albeit somewhat differently. On-balance volume looks at whether the current closing price is higher or lower than the prior close. If the close is higher, then the period's volume is added. If the close is lower, then the period's volume is subtracted. The A/D indicator doesn't factor in the prior close and uses a multiplier based on where the price closed within the period's range. The A/D indicator does not factor in price changes from one period to the next, and focuses only on where the price closes within the current period's range. This creates some anomalies. Assume a stock gaps down 20% on huge volume. The price oscillates throughout the day and finishes in the upper portion of its daily range, but is still down 18% from the prior close. Such a move would actually cause the A/D to rise. Even though the stock lost a significant amount of value, it finished in the upper portion of its daily range, therefore, the indicator will increase, likely dramatically, due to the large volume. Here are 3 key takeaways. 1. The accumulation/distribution, A/D, line gauges supply and demand of an asset or security by looking at where the price closed within the period's range and then multiplying that by volume. 2. The A/D indicator is cumulative, meaning one period's value is added or subtracted from the last. 3. In general, a rising A/D line helps confirm a rising price trend, while a falling A/D line helps confirm a price downtrend. Hope this would help. Thanks for watching.